So why focus on what you think is the percentage of the return versus what is the overall strength of the deal? And then the flip side, what my mentor, Dr. Nito Cobain, would say is, why focus on what the other person's getting? If you're happy with what you're getting, then it should be good enough for both. So that's his definition of a win-win. If we're both getting what we want, then how can it be bad?
Welcome to the Bulletproof Cashflow podcast. Let's get into the show.
Hey everyone, this is Agostino. For many building a portfolio in multifamily, we often begin by looking at alternative investment classes so we could build some diversification in our portfolio. The way I see it, self-storage is one of those more simplistic versions of multifamily. It's basically an apartment without tenants, toilets, and sinks. And this, of course, makes for a very interesting asset class to own and manage. Well, today's guest understands this aspect very, very well. He got his start in real estate in 1991 when he completed his Master's of Architecture and got started in multifamily shortly thereafter. By 1998, he began his own development build firm focused on single family, multifamily, and mixed use apartments. Now, since 2013, he's been focused on self-storage. Now, as the founder of CODA Management, he and his team focus on the management and development of self-storage facilities. The current portfolio consists of 47 syndications and over 2,700 units under management. Now, with all that, I'd like to welcome Scott Krone to the show. Scott, thanks for coming on, bud.
Thank you very much. I appreciate the opportunity to come and be interviewed. So thank you.
No, I think it's going to be great. Now, if you like what Scott has to say, you can reach him via the contact page at his website, codamg.com. And if you like our content, please don't forget to leave a comment and rate the show. It helps us tremendously when you do. Finally, if you text the word freedom to 202-410-4202, you'll get our free ebook, The Bulletproof Guide to Finding a Broker. Okay, Scott, go ahead and tell the listeners a little bit more about what your background is and your current focus.
Well, you did a great job of recapping it, so thank you. You saved me a lot of time and effort. But I did. So when I graduated from college, I began immediately pursuing my master's in architecture. And I was fortunate enough that my professor, who I was his TA as well, owned a real estate development design and build firm, an architectural contracting company. And so my master's thesis was a 400 unit development that was over $100 million in sales. And so from the beginning, I got to work on that 3 years in school, and then the rest of the time while in his office. But then while I was also doing that, I began running other projects for him, other condominium and multifamily projects for him, both apartments as well as condos. And, as you said, in 1998, I branched off and started my own thing at the ripe old age of 28, because of course, at 28, I thought I knew everything. How stupid was I back then? But that's where, we continued in the multifamily and the single family, and just really focusing on residential side until the crash came. And that's what pushed us more into the commercial side, because everything was going apartments. And you were talking earlier about cap compression. That's the first time I saw extreme cap compression, when everything in the distressed market was going towards apartments, and distressed apartments were trading at low points. And then, class A, class B were going at 3 and 4 caps. And I'd never seen anything that low before. So that's when I began thinking, we got to look at a different alternative investment. And I had a client that said, "Hey, I want you to find me a distressed self-storage." And I couldn't find one. We're at the height of the recession, and I couldn't find a distressed self-storage, which got me to thinking and really studying the model and understanding it. And you summed it up perfectly. It is a more simplistic version of apartments. It is, apartments without toilets and tenants. But ultimately, it's a lot more simplistic because we can model it out to the demographics. When we did our $100 million project, it was sort of like the Field of Dreams approach. Build it and they will come. We didn't have it. We're 400 units. That's a lot of apartments in a community, and a lot of it is speculating and hoping and guessing that people will come and buy these things. Now, granted, we were thinking that there's an older generation looking to get out of their single family homes and moving into a more simplistic living. But, the amount of data and research that we have now compared to back then is just phenomenally different.
Yeah. Well, I think that when it comes to self-storage as an asset class, and I think you've touched on this before, it's certainly very, very easy, and it seems to be a migration point for many people that are currently doing residential or multifamily type of scenarios, getting into that space, into the self storage space. But I think something you pointed out is the cap rate compression you saw back with that recession is back again today. And just for those that don't know what cap rate compression is, it's that when there's a lot of demand, you start seeing cap rates going down, 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 down. And the lower the cap rate, that's called cap rate compression, the higher the price of the asset, right? So, and we're seeing the same thing even today, even with with this pandemic going on right now, we're still seeing cap rate compression. And would you say that it's still going on in the self storage world? Is it still a thing?
Not as much as I saw it historically within the multifamily. The greatest compression that we saw was in the recession when Extra Space bought their portfolio to get them to propel them to the number one REIT in the country when they went 4.5. They bought a $1 billion portfolio at a 4.5 cap.
Wow.
And a lot of that, I mean, you're not going to see that on an individual basis. So a class B or C might trade at an 8 or 9, and that's a very good number. But I don't think you'd see them dropping into the sevens. I haven't seen anything in the sevens or six for that class. And consistently for Class A, we're seeing pretty steadily for the past 5 years between 6 and 6.5, depending on the market.
Right. And now, does it make sense these days? I mean, one thing that I've heard is that self storage usually tracks behind multifamily on a demand level basis. So if anybody follows the Black Creek Group, they have it looks like a wave, right? And they track different markets and how the individual multifamily deals are doing in a given market. And they say that self storage is often tracking behind it in terms of demand. Are you finding that demand is driving those cap rates, or is it independent of multifamily? Is it like how do you see it?
Yeah, I don't see necessarily the same correlation directly to new construction multifamily because of a lot of I mean, depending on the market. For instance, our Wisconsin and our Chicago markets, the housing stock is already there. But in our Dayton project, it's going gangbusters around us in terms of it. And that was one of the things that attracted us was how much development was going on around within a quarter mile of our site. Um, but ironically, in our Chicago location, the alderman was prohibiting the building becoming multifamily because there was too much density. And so we have 500,000 people within 3 miles, and 66% of them are renters. And so he didn't want more apartments going into that incredibly dense neighborhood. And so the building was sitting vacant. And so that's what we're seeing is that how to repurpose buildings that are having a challenge finding an alternative use because parking, zoning, density, all those sorts of things. And self-storage, make no bones about it, is still, somewhat the Cinderella, the ugly stepchild that, most community urban planners are not desiring. But yet it's zoned for it and they don't appreciate it. So in each situation, we have to go in there and make sure that there is an appreciation for it. In Milwaukee, after it was really strange because we had our zoning as of right when we bought it. And then 3 months later, they told us we didn't have it. And we said, well, we have our certificate. What do you mean we don't have it? And they said, well, we changed the definition. So you're no longer under storage. There's a new definition, self-storage. So you don't have it, but you can apply to get it. And so we went through that process to re-get the zoning, which we already had. But at the same point in time, they were doing it to limit other developers from coming in and putting more self-storage in Milwaukee. And we ran into that in Dayton, where despite the fact we were zoned as of right, they were prohibiting us from getting state legislative funding because they didn't want it. And so we had to come up with a compromise with them, and we carved out a little bit of retail to satisfy them.
Wow. So it sounds like there's a lot to this then. So a lot to unpack here. All
Yeah.
right. So it sounds to me like with anything else, like we're actually in the middle of we're going to be kicking off anyway a build out of a building to convert from office to multifamily, which the city is very much behind from what we understand. But when it comes to self storage, it's a little different, right? It's a little different. And do you think it's because the tax dollars aren't there, or is there some other? Is it just they just don't want to have self storage there for some other reason?
Well, granted, yes. I mean, all politicians look first and foremost towards money, right? So, tax and revenue, and it doesn't kick off the same sales tax as other things. That being said, it's not for being, a lack of a better term, a dark building in terms of lights off, no activity. Self storage presents itself as somewhat of a dark building because of the fact that it doesn't have the vibrant street front presence of those sorts of things. So when we're in an urban area where they're looking for a vibrant downtown community, I get it that self storage doesn't necessarily provide it, but that doesn't mean it's not a necessary service. Sort of like parking. You got to have parking in order to have the vibrant downtown. You got to have self storage if you're going to have condominium, apartment, dense living, because you can't get enough storage in those types of environments.
That's right. That's right. So now, okay, great. So let's say you're going to target a build out of a new facility. All right. Very different than multifamily in that in multifamily, usually you're tracking for income levels, job levels, a bunch of other things. With and you're also satisfying a need in Maslow's hierarchy that it's housing, right? People always need a place to
Mhm.
live. When it comes to storage, not so much, right? People don't need to keep their old crap somewhere, but they do,
It might
thankfully.
not be crap for others.
Correct. Correct. So, but how do you make that decision? Like, how do you determine that? Because when and I have some very limited experience with self storage, just in terms of the research side of things. But one thing that I've determined and I figured out is that it's like a whole business in itself, right? You really have to know how to not only buy the land and build on it, you also have to know how to sell it, how to market it, how to do all those things to really get the word out to the local people that you're building there. I mean, there's a lot to this, right?
There is. So I mean, you've asked a couple questions there. So there's two sides to this. So on the first side is the component of, well, let's take the sales and marketing side. Make no bones about it. We're real estate developers. We're not self storage managers.
Hmm.
So for us, it's easier for me to go and hire a CubeSmart under their third party management and let them focus on specifically what they do well, which is manage the self storage portfolio. We manage our overall portfolio and we can monetize and track revenues, all those sorts of things. But in terms of the day-to-day marketing, the day-to-day operations, that's what they do. They have, they're the third largest REIT in the country, so they have that expertise. I have to focus on what I do, which is building it. So when we build it, we have a lot more flexibility than if we're comparing it to condominiums or apartments. When we would do condominiums or apartments, you're basically looking for variation within your housing stock to make sure that you can fill the different demands and needs. Like I had one building that it had two options. It either had a one bedroom option or a two bedroom option, and it was 18 units. When we were doing larger products, we would have two or three one bedrooms. Like we'd have 25% one bedrooms, 50% two bedrooms, and then 25% three bedrooms. But then we'd have variation with them in order to, you would hit different price points so that you're not clustering. It was all about avoiding clustering your price structure so that you could meet the needs of your clientele perspectively. Within self storage, I have a lot more flexibility. But first, we're looking at what is the medium income to determine was what is the most optimal unit size. The higher the medium income, the larger they're willing to pay on a per square foot basis for self storage. The lower the medium income, they're willing to pay a higher premium for a smaller unit. And so when we look at that medium income, then we're going to, if the average is 90, we're going to either push it above or below 90 based upon that medium income. As we've built it, we did one project where it was a high medium income and we couldn't sell the 10 by 10s. All the 10 by 20s were sold out. And so what we did is we took out the middle divising wall of the 10 by 10s and made them into 10 by 20s, and they all sold out within a week.
Hmm.
I mean, it just, there's a lot more flexibility that I have within that product type.
Right.
I can't go and change, you know, unit configurations in multifamily.
Right. Exactly. I mean, because typically it's just like what, a thin steel wall just to unscrew it and you're done.
Well, all we
Basically.
did is screw it to the sidewall, so we kept the metal wall. Yeah, that's
Oh,
the
wow.
idea.
Yeah, that's amazing. That's amazing stuff. I mean, that's it's probably one of the flexibilities when you're putting one of these things together. Now, what would you say then is probably one of the more difficult components then when it comes to like putting one of these deals together to actually build out one of these assets?
Well, it's not the glamour child, right? So I mean, it's everything from making sure you have your entitlements, to raising capital to raising debt. I mean, it's becoming more popular now because more and more people are seeing that it's viable, especially in recessionary markets. I mean, we went back and studied. Okay, as you know, I've been in this since 1991, so that means I've seen, four major recessions, and apparently I saw one thing yesterday that we're already coming. We're not even going to officially go into a recession because the market has already rebounded, which is pretty amazing that we haven't even gotten through 2 quarters of a recessionary market. But so let's call it three and a half major recessions with a major downturn on that one half. Is that within that market there we have studied what has caused or how self-storage has done throughout those periods of times, and in each situation it's maybe dropped 1 point and then bounced back 2 or 3. So each downturn there's a drop and then come back. So we designated it as recession resistant as opposed to proof. It has a resistance built into it, and part of that is to touch in a little bit about what you were talking about before is inherently it's not about getting rid of people's junk, it's about dealing with change. So the four big drivers are divorce, uh, displacement, just overall change in someone's life, whether that be getting a new job, transferring, marriage situation, death. These are the major components within it. But and if you would look at the psychology in each of those, people are dealing with change, and it's hard to address significant painful change at one time. So it's easier to say I'm going to deal with that a little bit later, and if I have a viable solution where I can take care of this stuff, like if I'm losing my house, man, what am I going to do with all my stuff? I don't want to get rid of all my stuff. That's the harder part, right? I've already just lost my house. Or if I'm getting divorced, man, what do I do with all my stuff? Or death, a parent dies. How do I divvy up everyone's stuff to everybody else? And so it's a way in which we can help people through that change period. And so that therefore it gives them time. When in essence, what they're buying is time so they can process that pain in a later point in time.
Now, how do you find those markets then? Because I know you mentioned a few markets already. Are there? It's going to sound like a weird question, but are there certain areas, certain markets, or demographics, or something that these four components are just far more prevalent than other places? I mean, I don't know. To me, human nature is human nature, I suppose. But does the data say anything other than what I just said?
Yeah, so the market says that where supply typically equals demand in your basic economic, graphing, it's 7 square feet of lockers per capita. And that's across the whole country, except for what I deem the left coast and the right coast, and then the south. Uh, those areas, so California, along the Atlantic coast, Florida, Texas, it's all around 9. We're seeing the market go from 7 square feet per capita up to 9. And Florida's crazy. If you live in Florida, I apologize. I'm not calling you crazy. I'm just calling the state crazy, because they'll have 9 and 10 square feet per capita, but they're building brand new self storage right in the market, which all indicators should say like, don't do this, but yet it's still occurring. And so, do I understand that? No. And is that a market that I'm going to go into? No. I'm looking for markets that are under 7. So when we looked at Milwaukee, I don't know if you know what a Menards is, but it's like a Lowe's, a Home Depot. It's a Wisconsin thing. It's a Midwest thing. It was a 100,000 square foot building on 17 acres. It was all set up easily to convert into self storage. All we'd have to do is throw up the lockers and be done with it. But the density was low, and there was like 20 self storage facilities already around it. Within, I could be looking down the road, I could see self storage facilities. It was just the wrong market. We drove 10 minutes in Milwaukee, and we're under 2 square feet per locker, and it was a 100,000 square foot building. And so even in the same town, different markets because of the saturation levels. So we're predominantly looking for the Midwest. We're looking for underserved markets, and it's really a 3 to 5 mile radius. I mean, that's how specific that we have. I mean, we have to look at it and compare.
Nice, nice. Now, what sort of data do you use for this? I mean, in the world of multifamily, typically the usual suspects are going to be, city data, your Zillows, all that free stuff. Then, of course, you have the paid sources like CoStar, whatever. But I mean, I have to imagine when it comes to the world of self storage, you're getting your information from very different sources. I would think, right?
Well, I mean, the first preliminary source that we do is we find a building, we put in the address, and then I'll put in self storage near than the address.
Hmm.
And it's incredibly scientific. And
It's
so,
very
um,
simple, yeah.
so when I look at it, like I'll give you an example. This woman was telling me that she had this huge piece of property in Austin, Texas, and she was going to develop self storage. And I asked her if she had done her feasibility report, which is the next stage that we'll get to. And she said, "No, I figured that they would, I would order that later, and they would just tell me what to build." I'm like, "Well, you might want to do that first to determine whether or not you should build." And she's like, "Oh, I never really thought of it that way." I said, "Well, give me your address." She gave me the address, and there was 18 facilities within 3 miles of her property. And she's like, "I didn't realize there was that many near me." I'm like, "Yeah, there's 18." But then the second step for us is we send it to Cube, and then Cube comes back with a report, and they'll tell us what they know of what's coming online. And so we'll get a sense from them. And so at that location in Austin, Texas, there was 18, but 3 more coming online. And so the saturation was at 12. So I told her, I go, "Whatever you do not build self storage here. It will be a disaster for you."
Yeah. Well, I think it's like a lot of things though, right? I mean, it doesn't really register until you actually need it. Then when you need it,
Right.
you see it everywhere, right? And that sounds like the case of this lady. She wasn't really thinking about it from the perspective of, she doesn't need self storage. I'm sure she didn't need it. That's why she didn't think about it.
Absolutely.
That,
And then the next step we'll do is a feasibility report. We will order a full blown feasibility. I mean, we can do radius, we can do those things ourselves to determine, are we going in the right direction? But then we do hire feasibility consultants to come in and make sure that our assessment is not biased and we're getting a third party verification.
right. Now, is there a cost associated with that typically?
Well, yeah, I mean, we're paying a lot of money every year to get the feasibility reports based upon all of our sites that we do.
Got it. But for one of these other firms, these management groups to come in and really just tell you, thumbs up, thumbs down, that's usually a pretty simple discussion, I would imagine,
Yeah,
right?
but I mean, again, we have a relationship with them, so they know that we're not calling them out of the blue and just saying, "Hey, look, can you do this for free for us?" We're customers already, so they're willing to provide us with that.
Correct, correct. So now, so how does this work then? So maybe for someone listening right now, maybe they've identified this. Maybe they know that there's not a whole lot of storage going on in an area. Maybe they already have some land. Maybe they're in the same scenario as this woman you're just talking about. At what point should they be calling you and say, "Hey, Scott, I think we might have some land here we can develop into self storage." How does all that work, and what it might be some of the costs and other things associated with it?
Well, I think for your group and for your listeners, we'll offer this up for you guys that if someone comes in and mentions your show and when they sign up to do an appointment with us, we will review an opportunity for free for that group. And I mean, and if you want us to sign a non-disclosure, non-circumvent, we'd be more than happy to do it. This is a small world. We're not looking to steal people's properties. So, that's not our intent of doing this, but offering it up to you that if someone comes in and says, "Hey, is this a good deal? Is this a good site?" We will have a free call with them to go over it with them, why or why not it's worth pursuing. But if you want to do some due diligence on the front end, I mean, a simple thing is go into Google Maps, self storage near, put in the address, and just get a sense of how much is around there. The other thing I'll do is I'll click in the aerial and try to get a sense of what the housing stock is around it. Is it predominantly farmland? Is it predominantly single family homes, or is it pretty dense with multifamily or, mixed use and all those sorts of things? So we want to get a general sense of it. And then we'll begin getting into size and, is it big enough for what we're trying to do? Is it, what type of product we should put in there, and also what's the zoning? Those are all important things that we look for. And then once we get further, then it's the construction technique. How high are the ceilings? I mean, we went to one building in Racine, Wisconsin. It was in an opportunity zone. It had PACE financing. It was phenomenal. We went through the first floor, it was 14-foot high ceilings, and then we got to the second floor, it was 7-foot high ceilings. Done. Out of there. There's no way we could ever make it work.
Right. And you can actually apply for those PACE loans and OZ and all that stuff, even for self-storage, right?
We are doing those. So we were the first ones to actually do an opportunity zone and privately funded PACE in Ohio, if not the country. That combination of deals. We did it in Toledo. And this is back in 2018. So keep in mind that the OZ went into a law December of 17, and they didn't come out with the regulations until November, December of 18. And then they followed up the following spring with more regulations. But we closed on our property in November, and we had already funded an opportunity zone fund for our investors. They came to, we found out we were in a zone. I called the IRS to figure out what was involved with it, because, when I read the law, it was only like 3/4 of a page. And I'm like, this doesn't make any sense. It's like, it says, look at this form. And then I type the form in the IRS and the form doesn't exist. So I'm like, how am I supposed to figure this out? So I called them, and they're like, if you like to have a question about opportunity zones, leave a message. And so I left a message. I'm like, okay, great. Who's never going to call me back? Like 2 days later, I get a phone call from 414. And I'm like, I was in a meeting. I'm like, I'll take it later. And I listened to the message, and it was the IRS. I'm like, oh, darn, I missed the call. So I left another message, and I'm 3 days go by, and I see 414, and I was in another meeting. I'm like, I got to take this call. So I'm like, jump on the phone. It was the same IRS woman as the first time. And we spent an hour and a half going through how they thought it would be interpreted and intended to be facilitated, and like what I could do to shoot it down the middle of the fairway without being too risky to, either to get into the rough on either side. So I reviewed that with our attorney, because he had never been able to get hold of the IRS. And we had more questions. He goes, call that IRS agent back again. And I got her a third time, which was unbelievable. She called me back. I recognized the number. Now I have it in my phone. But she called me back, and we went through it again, and we set it all up based upon those initial conversations. And it turned out to be 90% accurate in terms of what we were trying to do.
Wow.
And so that's why, were we a little bit risky or aggressive? Perhaps, because the regulations all weren't out there. But at the same time, we were being very safe, because we created a designated fund for designated investors that they all went in at the same time. We could monetize the exact day and the amount of money, because it all went in exactly the same. And so it wasn't a matter of these funds that were money going in and going out in different times, and how do you track all that? And so we created the first opportunity fund.
Wow, that's amazing. I mean, the whole opportunity zone scenario years ago, a couple of years ago, it wasn't even that long ago, was all fairly new, and everyone was talking about it, but I don't think anybody was even applying it to regular old real estate, let alone self-storage. I mean, it was still fairly new, right? So that's funny. The deal that we're working on right now has a big opportunity zone component to it. So yeah, I think at this point now it's exactly what you just said. It's a huge part of the deal, and it really improves the returns of any deal. So it's amazing. So now in the case of that deal, how did it impact the overall return? Because I think you said that typically those cap rates are still fairly on the low side, right? Even if you're building it, it's still fairly low, right? 6-7%. Is that what you said?
Yeah. So, I mean, the way in which we look at it is so now we're on our third opportunity zone and PACE finance deal. So the first one was in Toledo, second one was in Dayton, and we're actually putting together one now in Louisville, Kentucky. And the underwriting principle on each of them is that we're not doing it because it's an opportunity zone. We're doing it because, first and foremost, it's a good deal, And then two, it enhances it. So, within our capital stack of that one, we're raising $2 million in cash. So within that $2 million, we have about 40% that's opportunity zone money. So it's got to benefit the people in the opportunity zone. We have IRA money, and then we have just regular cash investors. So it's got to make sense for everybody. But then on top of that, you're getting a 30% gravy with the opportunity zone because of the fact that you're sheltering that capital gain. So it just enhances that rate of return. So those are the things that we try to do is we look for ways in which to sweeten the deal for our investors. The first one is when we refinance out, they stay in the deal. We don't buy them out. We want them to participate with us because that's the true gravy. That's the why, if someone's eating with you in, 6 courses, why do you cut them off at dessert? Let them have, the sweet as well. Right. And so if we've sold cell towers, we've done historical tax credits, we've done PACE financing, we've done opportunity zones, and we're doing cost segregation. These are all tools in which we're utilizing to enhance our investors' rate of return. In the property in Louisville, because it's already in operation, we're going to be able to do a cost segregation the first year, and then once we finish construction, year 2, so they'll actually get a double cost segregation in tax liability and forced depreciation, that they'll almost recapture the value of their investment within the first 2 years in terms of a tax deduction, in terms of depreciation.
Wow, that is huge. That's huge. That's huge. So now, when you're putting these deals together, you're setting up the fund, you're raising the money, you're putting it all together. And it sounds like you're also getting outside management and on the deal too, right? Like you guys are not managing it. You've already made that clear, and then you're hanging on to it for 10 years, then, right?
Well, first and foremost, I'm in real estate, so everything's for sale, right? So, but with the opportunity zone, yes, we do have different restrictions and requirements that we're trying to meet in terms of accomplishing that. So, but keep in mind, they're two different entities. One is they invest in the fund, and then the fund invests in the property. So
Yeah.
that gives us a little bit more flexibility versus just investing in the deal itself. And that was one of the things the IRS told us, that they said, make sure you have an A to B to C relationship between these funds, as opposed to like an IRA. You can't disqualified investors in A to A. We don't want that. We want an A to B to C. So, we have flexibility in there in terms of what we can do. But, as Steve Glickman, we were both talking at the Opportunity Zone Fund conference in Las Vegas, and he said, worst case scenario is like, you go into an opportunity zone project and you sell it. You've just deferred your taxes for 3 years. What's the worst case about that?
Right. That's
So
right.
at minimum, you're deferring your tax basis.
Yep. 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 And then just like you said earlier, you outsource the management, and really it's totally hands off at that point, because I mean, for the most part, especially on new self storage, there's not a whole lot that goes wrong there, right?
Well, I mean, if it does it, we're all under warranty. So we have our warranties built in with all our subcontractors. So
Right.
yes, I mean, that's the beauty of it, is that, when we're doing the budgets with them, the, repairs and maintenance is a very small budget line item. I mean, brand new roofs, brand new mechanical equipment, brand new electrical, flooring, windows and doors, everything. So it's basically a new building.
Right. 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 I mean, and that's the beautiful thing about this asset class is that there's not a whole lot that can really break. I mean, the hardest part is really selecting the right area, getting through all the development side of things, the approvals and whatnot, which can be somewhat time consuming. But once all that's out of the way, it's a whole different set of problems, right? A whole different set of build out the development, all that fun stuff, right? So sounds to me like though it could take a little bit to actually put one of these deals together from the conception to turn up, right? I mean, you're talking a little bit of time, right?
Yeah, absolutely. I mean, and to give you a perspective, the building in Louisville, we began our due diligence we identified the building in November, and we began reviewing it in December. We didn't go to contract until, the end of March. And we're still in the due diligence period right now because of, you know, the doing the necessary environmental work. So, just that period of time, we're spending a lot of time and energy on. That's almost 9 months that we've been working on this project before, we're even closing.
And you still have to go through city approval. So you've already done all that, right?
Well, we have it's zoned as of right. So
Okay.
we've already met with the city in terms of the economic, historical, and pace. They've already given it their blessing, but we do have to still create. We're in the process of retaining local licensed architects so that we can submit for building permit. But at that point in time, that's our only approval. It's just going in for permits.
Yeah. So now, does this mean then you guys have like you as a business have like a bunch of these projects cooking at the same time? Because if you're only doing one or two at a time, I mean, there's a whole lot of bandwidth you could be using for other stuff, right?
Right. So right now we have the first one I ever did. We flipped. So that's one's off our books. The next within the first platform, the other two we're holding right now and we're operating. And then in platform two, Lawndale, we that's on Lawndale in Chicago. Interesting enough, it was the original Lincoln Log Factory
Hmm.
that Frank Lloyd Wright's son created Lincoln Logs, and they began building them there. So we went online the week before Governor Pritzker shut down the entire state, and we lobbied CubeSmart to stay open because we were deemed essential. And so we were able to convince them to not only keep our facility, but all of Chicago open.
Oh,
And
wow. Nice.
and so we're at 28% occupied in basically 5 months. And typically absorption is 3% a month, so 36 in your first year. So the fact that we've gotten 28% in 5 months is pretty phenomenal. So then we're opening up Wisconsin and Toledo. Wisconsin, CubeSmart is on site right now as we speak, getting the office and the computer systems all operational. So that one will be going online. That is our historic tax credit. So we have about $1.5 million in historic tax credits that will be either giving back credits in the form of taxes to our investors or cash. So we're giving back the federal, but we're selling the state because we only have one investor in the state, and there's no point in having state tax credits if no one lives in the state. So we will be returning that cash to our investors. And then our one in Toledo is opening up this month where we have fire alarm inspection. Everything else is done. And then Dayton, we're under construction. In Louisville, we're going to be getting going at the end of the year.
Excellent. So more than enough stuff to keep you guys busy while you're
Yeah,
working on these long tail deals.
exactly.
Excellent, excellent. Now, Scott, if for someone listening right now, what piece of bulletproof advice would you give them if they're listening to this conversation and they're thinking about self storage? What bulletproof advice would you give them?
The thing that when I'm talking about with investors is they say if they're comparing deals, make sure you're really comparing apples to apples because they'll say like, well, on this deal I get 80% of the deal, but on yours I'm getting whatever 50 or 40 or let's be extreme as much 20%. And my point is, why are you focusing on the percentage as opposed to how the strength of the deal? So if the 80% is giving you 80% in order to yield you 11%, why is that better than if another deal is giving you 20%, but they're yielding you a 20% rate of return? Because it should be that much stronger if they only have to give you that little bit to give you that great of a yield. So why focus on what you think is the percentage of the return versus what is the overall strength of the deal? And then the flip side, what my mentor, Dr. Nito Cobain, would say is, why focus on what the other person's getting? If you're happy with what you're getting, then it should be good enough for both. So that's his definition of win-win. If we're both getting what we want, then how can it be bad?
Right. No, love it. Love it. Love it. It's like, I think people get mixed up with the size of the pie, and it's like, well, that pie is bigger than that pie is bigger than the pie you're offering. But if you have apple pie and the other one's not so good, the apple pie is going to be better.
Exactly. It's a lemon meringue.
There we go. There we go. There we go. There we go. All right, guys. Well, guys, if you want to reach out to Scott, you can reach him via his website at codamg.com. I hope you got some insight on how you can leverage self-storage to building some steady cash flow for your portfolio and some of the stuff that happens in the background as well. So definitely look into it if you're really interested and reach out to Scott too. So thanks for tuning in, guys, and I will see you in the next episode. Take care.
Thank you for listening. We hope you enjoyed the Bulletproof Cashflow podcast.